the world blew up in 2008. The world is now entirely about the management of the debts. That is everything now. And there are two ways for that to happen. If we didn't do quantitative easing in 2008, 9, 10, 11, all of that stuff, the world would have burnt and destroyed in the manner that you thought, which is like the Argentina collapse, the Cyprus collapse, this huge destruction. What we chose was a glide path.
In his latest interview, Real Vision founder and CEO Raoul delves into the imminent threats facing the global economy, which he terms as the Great Unraveling. Leveraging his profound understanding of macroeconomic trends, Raoul provides invaluable insights for investors and market observers, enabling them to grasp the gravity of the situation. At the core of Raoul's analysis is the assertion that we are on the verge of a monumental debt crisis, a ticking time bomb set off by attempts to avert an economic collapse following the 2008 financial crisis. Central banks worldwide have injected trillions into economies through quantitative easing. However, this approach has only fostered an unstable environment characterized by excessive risk-taking, artificially inflated asset prices, and skyrocketing corporate and sovereign debt. From Raoul's perspective, this suffocating burden of debt is poised to ignite an irreversible and devastating chain reaction. He portrays the global economy as a complex interconnected system, where the fall of one domino will inevitably lead to the collapse of others. Make sure to watch the video until the end, where Raoul breaks down what he believes to be the sole life raft for investors. He also shares his insights on economic growth and population productivity.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
This is important. Is it something I call the magic formula? Magic formula is economic growth. Economic growth is driven by three factors and three factors only at long-term level, aside from just the normal business cycle ups and downs. Population growth. The more population you have, the more your economy has activity. So population growth, population shrinking the entire Western world. The only way of offsetting that is immigration. But we talked about the fact that the workers are angry, they can't get wage rises. There is less of a desire to have immigration than there was maybe 20 years ago. So most countries have started to restrict immigration. Fine. So there's no way of solving the population side. The next part of the magic formula is productivity. That's how much output each of us can generate for the economy, and that becomes more efficient. Problem is, it seems to be a function of demographics too, and productivity has been declining since the 70s. Well, actually since the 50s. So productivity is going down. The population is shrinking over time. So the answer was debt. The answer all the way through this equation, from these people who were sold the American dream back in the 1950s, the baby boomers, they're listening to Elvis Presley, getting into the Beatles, they're like, let's go, the American dream, I'm going to get rich. But as we pointed out, their wages never went up. But because there were so many of these people, they competed for houses, and houses went up. They invested in the stock market went up. Everything, all assets got more expensive because of their demand. So they did the rational thing, which is I'm just going to borrow money. And the difference between the rise of the assets and their wages is essentially what the debt was. The debt side of the equation is what the government's done too, because GDP is declining. The trend rate of GDP keeps going down. Economy, and what happened is they did the same. They had population coming in, productivity probably rising, but then they massively borrowed money. So they had the fastest growing economy in the world for a long period of time. Leverage gives the illusion of growth, but obviously it has a payback later. And this is the payback we've got now. The leverage that the baby boomers took on, their governments took on, and the corporations took on for all of this issue is what we're dealing with now. So wages didn't go up, assets went up because they were competing for them, like you're competing for scarce resources of people right now. But when you put 76 million people in, the housing market goes up. The stock market goes up because they start pension plans and stuff like that. So the difference is debt. And that was okay. Although we were all starting to look at this saying, whoa, this is now getting absurdly debt laden. The government's 100% of debt. The private sector's 100% of debt. Households are 100% of GDP in debt. It's like, whoa, this is out of control. Then 2008 comes along. And that is the debt crisis. I mean, every fucking bank blew up. I mean, everything blew up. It was a complete, total collapse. And that rolled on into Europe in 2012 when the governments, Spain, Italy, etc., blew up. Hyperinflation is when you issue more money to pay your debts, and it comes in an endless cycle because you're not generating GDP growth, so you just keep printing money. So an excess of anything, in extremis, everything becomes worthless. So if you're thirsty and you've come out of the desert and somebody gives you a bottle of water, you'll pay pretty much anything for it. If somebody's there with 1 million bottles of water, what's a bottle worth to you? Almost nothing. Once you've had the first one, right? So anything in excess supply, just supply and demand. Too much supply of currency, the value goes down. So what happened in Germany is they had these gigantic, impossible to pay debts to the West. So they printed as much money as possible. That blew up spectacularly. Prices rose millions of percent.
And really fast, I want to use a different word for people, and a shout out to Robert Breedlove for introducing this idea to me. If you change one word from print to counterfeit, people understand what's actually happening. And so if you think of printing money as government approved counterfeiting, then it's like, oh, because I think people have an intuitive understanding for why counterfeiting is bad, but I certainly didn't have an intuitive understanding for why government printing is bad, which shame on me. But once I realized, oh, yes, this is literally the equivalent of a guy at home with a printing press just making more money.
That's right. But so let's carry on with the story. So the Germans destroyed their economy. The people got angry.
Because the only way to pay their debt was to make up fake money. Fake, it's not really fake, but they make it up so they can pay it.
And every time you got paid as a German citizen, that fistful of notes barely bought you a loaf of bread one day and half a loaf of bread the next day, and then nothing at all until you have wheelbarrows full of cash. And we've seen this in Argentina, we've seen it in Venezuela, we've seen it in plenty of countries. We just saw it in Lebanon recently as well. That's a total collapse of the value of a currency. Okay, so therefore, all of your productivity as a human is devalued as well, because you can't buy anything. So you end up having to ignore currency and barter. And we've seen that in many places as well, because the value exchange of a currency in the middle, because it falls so fast in value, it's a nightmare to deal with. And it's a total destruction of wealth, except those who own assets. Real wages have not gone up versus prices.
Okay. Meaning
so prices rose more than wages. So if you look at peak, I don't know what peak wages were, but let's say they were 6% last year, year-on-year wage growth, but peak prices were 9%. So people actually got poorer, which is why we've got a recession going on, because everybody lost purchasing power versus just basic goods.
So would you say we are in a recession already?
Yes. Yeah, by every indicator I've got, we're in a recession already. And it will become more abundantly clear. The other thing I think is a point that's also important is we need to think about total aggregate demand within an economy. And who are you giving those increased wages to, right? So yes, you are paying more for scarce labor, certain skill sets, expertise, whatever. But when the labor force participation rate is only 65%, you have to average that over 65% of the economy, not 100%. And that's the function of demographics. So there's a whole bunch of people who are retired whose wages can't go up, which is retirees, which is basically that 35% is that bucket plus people who've opted out. So you actually reduce it by that. And the labor force participation rate is actually a function of the birth deaths rate forward lagged 30 years. So what we know is, we know in the future that there's going to be less and less people in the workforce. which is interesting, and it actually mirrors inflation, GDP growth. Everything's driven by this monumental demographic issue. So yes, you're paying up for wages, but your margins have gone down anyway because the other costs of input. So real wages for everybody have actually gone negative, massively negative, which is why everybody's feeling the pinch.
In the discussion surrounding the impending great unraveling of the global economy, Raoul takes center stage. The primary culprit behind this scenario is the looming debt crisis. However, amidst the prevailing doom and gloom, Raoul proposes that exponential age technologies such as AI and cryptocurrencies could serve as a safe haven asset class for investors navigating these turbulent financial waters. The World Bank's recent Global Economic Prospects report further validates Raoul's analysis. The report paints a picture of decelerating global growth, particularly in emerging and developing economies, where financial strain intensifies due to rising global interest rates. These economies are projected to experience significant growth slowdowns this year, posing formidable challenges for job creation, poverty reduction, and overall prosperity. Furthermore, emerging markets and developing economies not only grapple with systemic challenges but also become increasingly vulnerable to shocks due to restricted global credit conditions. The repercussions are evident in lower growth projections, heightened debt pressures caused by higher interest rates, and a stark decline in per capita incomes across many low-income countries. Nevertheless, amid these sobering prospects, Raoul emphasizes the potential of AI and cryptocurrencies. As the world contends with mounting debt, declining growth, and deepening financial distress, these technologies hold the key to navigating the turbulence. Before concluding, we invite you to share your thoughts on these global economic forecasts and Raoul's outlook on AI and cryptocurrencies. Please feel free to express your opinions in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.